Hey everyone, welcome back to Wealth for You. So, let me ask you this. Do you remember the good old days when Singapore REITs were like that reliable Kopi uncle? Always steady, always serving up hot dividends? Fast forward to now, and it's been a bit more like Kopi spilled on your white shirt. Painful. But here's the big question. Could 2025 be the comeback year for Singapore REITs? With Trump shouting at the Fed to cut rates, inflation slowing down, and dividend yields looking juicy again, there might be a once-in-a-cycle opportunity right in front of us. And if you're someone who wants consistent passive income, or you're just tired of low bank interest, then you'll want to watch this till the end. I'll break down on what really happened to REITs over the past few years, how interest rate movements affect your dividends, what the Fed is likely to do next, with or without Trump's drama, and whether now is the right time to buy into undervalued S-REITs. So please like this video and subscribe to Wealth for You, so the YouTube algorithm knows this is content every Singapore dividend investor needs to see. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research or speak to a licensed financial advisor before making investment decisions. Chapter 1. What are REITs and why do interest rates matter? Let's do a quick refresher, just in case you're new here or need a simple breakdown. REITs stand for Real Estate Investment Trusts. Think of them as big property landlords. They own things like your favorite shopping malls, office buildings in Raffles Place, industrial spaces like warehouses and factories, and even healthcare facilities like nursing homes and hospitals. Here's the key reason why income investors love REITs. By law, Singapore REITs must pay out at least 90% of their rental income to shareholders like you and me. This payout is called DPU, distribution per unit. So when tenants pay rent, you get a slice of it as passive income. But here's the twist, and it's important. REITs don't just sit on cash, they borrow money to grow their portfolios. They take loans to buy more properties or upgrade existing ones. So when interest rates go up, their loan repayments become more expensive. That eats into their profits, which then squeezes the amount they can pay out to you and me. That's your DPU slowly getting squeezed like lime into your mee siam. And guess who sets the tone for global interest rates? The U.S. Federal Reserve, also known as the Fed. Even though we're in Singapore, interest rate moves by the Fed ripple across global markets, including the rates our REITs pay. That's why Fed meetings are like exam results day for REIT investors. One rate hike, and everyone's heart skips a beat. So when interest rates are low, REITs thrive. When rates shoot up, they struggle. It's really that simple. And it's why what happens next with interest rates matters a lot to dividend investors like us. Chapter 2. What happened to S-REITs? Let's rewind a bit. From around 2010 to just before COVID-19, it was the golden era for S-REITs. Why? Because interest rates were super low, like Kopi Peng Kosong kind of low. This made it very cheap for REITs to borrow money. And when borrowing is cheap, REITs can buy more malls, offices, warehouses, and so on, renovate or enhance existing ones, and expand into new markets like Australia, Japan, or Europe. All that meant more rental income, which translated to more distributions, or DPU, for investors like you and me. Life was good. Dividend investors were smiling every quarter. But then, along came 2022, and it brought drama. Big drama. The U.S. Federal Reserve, or the Fed, suddenly decided, hey, inflation is too high, we better do something. So they raised interest rates, and not just slowly. They aggressively hiked it from nearly 0% to over 5% in less than 2 years. And here's where the pain started. Remember, REITs are like property giants with loans to pay. So higher interest rates mean higher borrowing costs, smaller profit margins, lower DPU payouts, and unhappy dividend investors. The S-REIT index dropped by almost 30% from its peak. Some of the more vulnerable REITs like Manulife US REIT and Prime US REIT didn't just fall, they crashed, like crypto meme coins after hype dies down. Investors who were chasing high yields without looking at quality got hit hard. It was a painful lesson that reminded everyone, REITs are not bulletproof. But here's the thing, after the storm comes the calm, and maybe, just maybe, a turnaround. Which brings us to what the Fed might do next, and how that could change the game for Singapore REITs in 2025. Chapter 3. What's happening with the Fed now? So what's the story in 2025? Well, the Fed already cut interest rates once in late 2024. It was a small move, just enough to signal, okay we're done hiking, for now. But since then, radio silence, pause mode. Why? Because inflation is still a bit sticky, like kaya on warm toast, sweet but stubborn. At the same time, Trump is back and making noise louder than an MRT breakdown. He went full truth social mode, calling Fed Chair Jerome Powell a disaster for not cutting rates fast enough. Yes, really, classic Trump. But here's the important part for us as investors. Morningstar expects the Fed to cut rates by 2 full percentage points by mid-2027. That would bring the Fed funds rate down to around 2.25 to 2.5% from today's 4.5%. So, what does this mean for Singapore REITs? Let's connect the dots. Lower interest rates mean cheaper borrowing costs. REITs usually carry a lot of debt. That's how they expand their property portfolios. If borrowing becomes cheaper, their interest expenses go down, and more cash is left for investors. That means more stable, or even rising, DPU. When REITs have more wiggle room, they can maintain or even increase distributions, especially if their rental income holds up. That's extra COPI money for us. Valuations tend to go up as interest rates fall. As yields from T-bills and fixed deposits become less attractive, investors start looking back at REITs for yield. Demand goes up, unit prices rise, and that's where capital gains come in. In short, if the Fed cuts rates further as expected, it's a tailwind for S-REITs. But here's the catch. You don't make the most money when REITs are already hot and everyone's rushing in. You make money when they're still cold, undervalued, and nobody wants to touch them, just before the rebound. Which brings us to our next chapter. Chapter 4. Why you make money when REITs are undervalued. Let's be real. You don't make money buying REITs when everyone is talking about them on TikTok. You make money when they are unloved, undervalued, and ignored. Like now. Just look at the current price-to-book ratio for S-REITs. It's hovering around 0.85, below the 5-year average. That means many REITs are selling for 85 cents on the dollar based on their actual asset value. Take CapitaLand Integrated Commercial Trust, or CICT. It owns high-traffic malls like Raffles City and office towers in the CBD. It's paying a dividend yield of over 5.6%, and its occupancy is still over 95%. Not bad, right? Or look at Frasers Centrepoint Trust, FCT, which owns heartland malls like Causeway Point and North Point. It's yielding nearly 6% now and trades below book value. These aren't risky meme plays. These are solid income assets on sale. Chapter 5. Should you buy S-REITs now? Okay, let me be clear. I'm not saying YOLO your entire CPF OA into REITs tomorrow, but if you're a Singapore dividend income investor who wants passive income every few months, hopes to ride a rebound when interest rates fall, and believes in buying low and collecting high, then yes, this is one of the best windows we've seen in a while to start accumulating quality S-REITs. Let's get real. You don't make money buying REITs when everyone is shouting about them on Reddit or financial news. By the time the REIT is hot, the price usually is too. And that means you're paying a premium, while your upside is limited. The real money? It's made when the market is gloomy, when prices are beaten down, when investors are scared and running the other way. That's when you quietly accumulate, collect your distributions, and wait for the rebound. Right now, the S-REIT index has dropped nearly 30% from its highs. Price-to-book ratios are below historical averages, around 0.85 versus the 5-year average of 0.99. Dividend yields are at juicy levels. Some REITs are giving 5.5 to 7%. Let me give you two examples. First, CapitaLand Integrated Commercial Trust, or CICT, owns malls like Plaza Singapura and office buildings in Raffles Place, trading below book value, offering a dividend yield of around 5.6%, occupancy above 96%, strong rental reversions, and stable DPU. Second, Mapletree Industrial Trust, strong industrial and data center portfolio, including in the U.S., yield above 6%, diversified tenant base, and prudent gearing. So, you're getting paid regular income while you wait. And when the Fed finally picks up speed on the rate cuts in 2026 and 2027, that's when capital gains may start kicking in. The smart money doesn't wait till the rebound is confirmed. It positions early, patiently collects dividends, and lets time and recovery do the work. And it is important that income investors stick with REITs that have strong balance sheets, look for low gearing, high occupancy, and stable or rising DPU, and diversify across sectors: retail, logistics, healthcare. Don't just bet on one horse. So, should you buy S-REITs now? Only if you like buying things on sale. Final thoughts. So, is now a good time to buy Singapore REITs? If you're someone who believes in long-term investing, if you love seeing passive income drip in while you sleep, and if you've got the patience to wait while others panic, then yes, this could be a golden window to start accumulating quality S-REITs. Because let's be honest, it's not just about timing the market. It's about time in the market, especially when prices are low, valuations are attractive, and dividend yields are this juicy. You don't need to get the bottom perfect. You just need to get started when things are still undervalued. If this video helped you think a little differently about Singapore REITs and dividend investing, please give it a like so more income investors like you can discover this content. And hey, subscribe to Wealth for You for more easy-to-understand, no-fluff dividend insights. Because building cash flow is not just for the rich, it's for you. Thanks for watching, and remember, don't be rich, be cash flow rich. See you in the next one.